listening to Real Estate Radio Washington, D.C. Metro on the Big Talker 1580. Now, live in studio, your host, local real estate expert, Ryan Sloper.
Sloper's Real Estate Radio, the most important hour of radio every Monday on 1580 AM, the Big Talker. Thank you for joining me this afternoon. For those of you who don't know, Real Estate Radio is a show dedicated to building the Washington, D.C. Metro's housing and credit markets one house at a time. Within every market, there are solutions as well as tremendous opportunities. You just need some trusted advice. That's my message, and I will be delivering it to you guys every Monday from 2 to 3 p.m. right here on 1580 The Big Talker. We've got some great topics lined up, great guests. First on our panel today is Louis Cammarosano, who's the general manager of HomeGain. Louis is often cited in the media as an industry expert in the Wall Street Journal, Forbes, CNN Money, Fox Business, Smart Money, MSN, and numerous others. We're going to discuss with you what happened in the markets last week, as well as letting you know what's on deck for this week and how it's going to affect you and your real estate, mortgage interest rates, everything that you need to know. So stay tuned. Also on our panel today is Sean Murphy, a real estate agent with RE/MAX Allegiance, and he's going to discuss the local real estate markets and, in particular, Alexandria and Arlington. It's great to have both you guys on. Louis, how you doing today?
I'm good. Yourself, Ryan?
I am doing well, my man. I was just discussing before we hopped on air, the headlines have been predominantly dominated by the Casey Anthony murder trial for the last week, so I haven't, there hasn't been as much real estate stuff coming across my desk. It's been that murder trial, which is actually, I was telling the guys here, it's interesting because that, she was obviously found not guilty, having, her daughter that was, she supposedly murdered. I think she was guilty, but wasn't found that way. And then I had actually my veterinarian who took care of my dog lived like literally probably I could see her house from behind mine. Her son, I don't know if you heard this, Louis, in Bristow where I live. She actually went to work and left her 2-year-old son in the car for 7 hours.
Ooh.
And she went home, and what happened was I guess she walked in the house. And the husband was like, the kid wasn't at daycare. And she's like, what do you mean? So she runs out in a panic and just starts running around the neighborhood. Like she knew she didn't want to walk into the garage because her kid was in there. So it was just like one of those things that, you watch that, like the murder trial there, and then something like that hits you that close to home. It's like, that was my vet. How could that happen? She was such a nice, caring lady. And but the bigger thing with it, I guess when they did the investigation, this wasn't the first time she left the kid in the car. There was another time where the kid was sitting in there for 20 minutes, and the Miniland called her office and said, so-and-so's not at preschool today or whatever. And she ran out to the car. Kid was sitting in there. So now she's being prosecuted for felony murder.
Oh.
Yeah, and it's amazing to me because I'm like, and I try to like compare that to the Casey Anthony trial, and I'm like, that woman got off in my view. And now this lady, she could be potentially going to jail for a long, long time. And it, maybe more of a true accident than anything else. But it was just, it's pretty scary when you think about it. I know I had my wife in like a tizzy for like the last 2 weeks. That's all she could think about. But on a lighter note, we're going to jump into what happened last week. We're going to jump into our Word on Wealth segment. This segment was brought to you by HomeGain. HomeGain is the place to get you started buying or selling a home, finding a real estate agent, and getting real estate questions answered. You can go to homegain.com today to see what I'm talking about. All you have to do is type in your home address, and you will get an instant free estimate of your home's value online. It's a great way to monitor your home's value, and it's totally free, so check it out today at homegain.com. So last week was obviously a shortened week. We had the 4th of July weekend. Monday was the 4th of July. Wasn't obviously much going on in the market. On Tuesday, Casey Anthony was found not guilty. That just seemed like it was the biggest story dominating the headlines, is what I had said. On Wednesday, Moody's downgraded Portugal's credit rating to junk. Now, this is interesting because it just shows how serious the issues are in Europe. And Louis, you and I have discussed on numerous occasions that, the U.S. is not immune to these same problems down the road. Maybe not right now, maybe in 3 to 4 years, but this is something that obviously that, it's a contagion over there, and it's spreading from one country to the next. I believe we were talking about Italy this morning. Did you hear that?
I did, and Italy is probably is too large of a country to bail out. Germany can't bail out Italy. I don't think the United States can afford to bail out Italy, nor can China.
We can't afford to bail out ourselves, so.
Well, that's the problem right now. All the sovereigns have gotten in over their heads, and they have, as you say, kicked the can down the road. But at some point, that road is going to be a dead end.
Yes.
There's not enough. They cannot print their way out. They can't issue more debt out of a problem which is caused by too much debt in the first place.
Yeah, I totally agree. And, it's interesting because the media has created this frenzy about this debt ceiling and how it has to be raised because bills have to be paid. I think it's my opinion that this is just for show. They're not going to default on their debt. The U.S. is not going to let that happen. They're ultimately going to, continue to raise the debt ceiling, and it's just a matter of, political banter back and forth at this point.
And that's really what the problem is that they don't really take it seriously. Oh, we'll just increase it a few $100 billion more, and the problem will go away, or it'll be someone else's problem, or it'll be a problem 3 years from now when they're not in office.
Absolutely. And, the thing, it's interesting. I think the Treasury auction takes place today. And why this is so huge, this is going to be the first time that the Fed isn't out there actively purchasing Treasuries. Why that is significant is because we want to actually see what the private sector demand is for these Treasuries, because ultimately we can start to see that tick up in interest rates that we've been talking about for a while.
It's interesting. I just have, because I don't trust the Fed, is they could have buyers that they're funneling money to go ahead and purchase the security. So who knows?
Yeah. And you are right, because I heard that, in case they did not raise the debt ceiling and they were forced to have to, make the decision for who was not going to be paid and who wasn't going to be paid, that the Fed was already working on a contingency plan. So that leads me to believe that, they have an alternative to this already if that were to happen, even though I don't think it's going to happen.
It's funny. You don't know what the Fed is doing. They've never been audited, and then they've had these recent looks into the books, and you find out 6 months later that a lot of the bailout money went to foreign banks, Harley Davidson. You just wonder where they come up with and what the arrangements are for these deals for the Federal Reserve to send money to countries, companies all over the world.
Yeah. And, my big concern, too, is, when you keep this federal funds rate low for so long, as when Greenspan was in office, what are the potential implications for real estate? Obviously we created a bubble the last time by keeping interest rates too low for too long. And we've discussed numerous times on this show that it's kind of good to let the free market take its course. That's not what's going on right now. We do have a lot of artificial manipulation in the market by keeping interest rates too low. You're talking about 4.5%. Historically low, and your average investor that comes into the market that wants to lend money wants to make more than 4.5% on their money.
Sure, what they're trying to do is to keep the housing prices stable and where they might otherwise fall. And you might say, well, I'm not going to buy a house because prices may fall, but the flip side to all this, though, is they're so debasing the currency and they're keeping rates so low, and at some point they're going to have to raise rates that even if you overpay for a house now, if you're paying back in debased currency or inflated currency, you should be okay, because at least you'll have an asset.
Exactly.
But it just seems like where we're headed with all the sovereign entities devaluing their currencies with impunity to avoid a short-term problem. They're creating a catastrophe, I think, long-term, because there has to be a limit to the amount of money that the European central banks and the United States can print up to solve debt issues.
Yeah.
And then the other problem with China, you say, well, China's always there, but I believe that China holds a good portion of their wealth in U.S. dollars, so it's not going to do them much good for the United States to go to the dollar to collapse either.
Not at all.
So it seems like, owning a home, owning commodities, owning silver and gold seem to be the better places to be if you have all this uncertainty on whether you're going to get paid back in dollars or at all from the U.S. government.
Exactly, and especially long-term plays. Real estate, like we've discussed numerous times, we went through that period of time where real estate was like, a hot little fad where everybody wanted to buy a home and flip it and, make just 3 or 4 moves.
That's right. That was a speculative investment.
Exactly. Now, I think it's more of, people are looking at it as a home as a long-term investment. And why not at 4.5%, like we've been talking about for so long? I was discussing with Sean last week that, we have, the 5-year ARM interest rates in the Washington, D.C. metro area. You're talking at 3%. So if somebody's going to move into the area and they're in the military or something like that and they plan on, buying here, they could buy in if they're going to put a decent down payment and have a rate around 3%.
And Ryan, especially if the real inflation rate is higher than that, they're paying you to take their money so you can go out and purchase an asset.
Yep. Exactly. You know, it's interesting. Later on last week, it was kind of funny. The stock market started shooting up because those ADP employment numbers looked like they were coming in better than expected.
Yeah.
And then Friday, boom, the unemployment report hit, which was ugly. Everybody was expecting that to get better. It rose. It moved up higher to 9.2% from 9.1%. And Sean, I wanted to ask you, I know you deal a lot in the Arlington and Alexandria markets, so
Right.
and with a lot of first-time home buyers. What are you seeing as far as employment affecting the people that are looking to buy in this area?
But it really hasn't had as much of an effect in the D.C. metro area. A lot of my clients are probably government contractors and government employees, and so we're really not seeing the huge problems like you are in the other parts of the country. So it really hasn't had a huge impact in Arlington and Alexandria, where I have, you have the patent office and tons of people who work at the Pentagon. So we're not really seeing these, huge problems. And then with first-time home buyers, there's been people out there waiting for the right time to buy, and a lot of people are realizing that now is the time with rates so low. So they've been saving their money, so now they have that down payment where they can make that investment.
Right, you're seeing, interesting statistics that you were throwing out to me earlier were the percentage of loans or the type of loans for the last transactions for all of June. You want to give those numbers again? This is for Fairfax County, which is, the largest county in the state.
Right. Yes. I took a look at it, and VA loans were actually 12%, which, you probably see more VA loans in this area than other parts of the country. Cash deals are actually 11%. Of the homes sold in June were cash deals, and then conventional loans were 60%, and then FHA was 17%.
Yeah, and those numbers are actually, very interesting. We were kind of discussing before. I wouldn't expect to have such a big majority of those loans being conventional. That's a very good sign, in my opinion, because that means that people have saved up quite a bit of money, or they were sitting on the sidelines for a while and are finally realizing, okay, let's take this cash and invest in a home. If I was seeing 50 or 60% with FHA, I'd be a little bit more worried.
Exactly, and that's how it was, 2-3 years ago. I remember when I was selling REO properties or foreclosures, and I would have to report to the banks what type of loans were out there in different zip codes, and the ratio was more, when comparing conventional to FHA, it was closer to 50-50.
Yeah. Yeah, that is a very good sign to me. That kind of, it's not that people are just out there buying houses, but they're actually putting some skin in the game. I know the government's been big in trying to regulate loans and coming up with some sort of quality residential mortgage where people have to put a minimum of 20% down for conventional mortgage. I don't necessarily think that that's the smartest thing to do. It's just you need to really look at the individual potential borrower as a whole, like what's their credit, what's their down payment, what are their reserves, and not just kind of throwing everybody into one category. I think common sense underwriting, which during the boom it was a little crazy because there was a little too much leeway there.
Right.
But in certain instances, and I tell people this all the time, we could actually have nationally our real estate markets come back by just opening the guidelines up a little bit for a potential stated income loan. Now, I know a lot of you are out there talking about, would say, Ryan, why would you want to do another stated loan? The reason why stated loans were ever, brought about in the first place was for the self-employed borrowers. Obviously, you're a real estate agent. I do loans. We're self-employed people. So we're going to tend to write a lot off on tax. We have a lot of expenses. Doesn't mean you don't have the capacity to pay back. And there's a lot of people that have $500 or $1 million worth of assets sitting out there. They can't get a $200,000 loan.
Right.
It's completely backwards to me. If you got enough money in the bank to cover it, now they're going to say, well, why don't you just put all that money down? Well, you can take advantage of the tax benefit. You should be allowed to take out that loan. So it's kind of interesting because, I think that slowly we will start to see some private money come back into play. I've already started seeing it, hard money. Interest rates are not obviously as intriguing as 4.5%. But I do feel like, in the next year or so, we're going to start to see that open up a little bit. And I think that would help the national statistics a little bit as well. Lewis, I know there's a lot of depressed areas out there, but I think, we have, like in Fairfax, 11% are cash sales, but if you open that up a little bit and you actually allowed for stated loans, but the borrower's putting 20 or 30% down, there's less risk to the lender. They have a physical asset that they could come back and take.
Now, in a free market, you'd take that bet most of the time.
Absolutely. I would lend my money all day long. Let's just say I was a billionaire. I'd be out here all day long lending money to an investor that wants to put 30% down, because I know based upon that, and if they have a decent credit score, let's just say 680, what's the chances that they want to walk away from that deal? They don't. They don't.
It's not quite a secured lender, but if you have stated assets, you at least know where the person stands, at least at the moment when you make the loan.
Yeah, exactly. And I'm a proponent of probably doing something along those lines. Just, you're allowed to state your income. It has to be reasonable for your occupation. But you got 12 months worth of payments in your bank account. That's very low risk to me.
Especially if you can get some sort of agreement to not let that bank account go below a certain amount.
Yeah. There's all kind of things you could put in place, but I just think that these are the type of things. The lending is the big caveat in this national scene, and I think that's why we're seeing numbers in the Washington D.C. metro area that we're not seeing in the rest of the part of the country, because a lot of money is in the surrounding areas with the government contractors. We have a lot of self-employed people. We have a lot of investors, a lot of hedge funds, and everything else that want to buy properties.
The question for you two gentlemen is, what happens if there are significant cuts as a result of this debt ceiling negotiation, and those government contractors start to lose their contracts?
Well, I'll answer, and then I'll let Sean give his take. My take on it is that, anybody can lose their job on any given day, I guess, unless you're self-employed. A government employee, you're working for the government, so if they decide to cut you, then they do. But, if let's say that you were planning on buying a house, do you have to be forward thinking 2, 3, 4 years down the road, or do you make the move now and try to secure your low interest rate? To me, I would say that if it makes financial sense for you today, you've got enough money saved up, I would venture to say it's a great time to still buy. I don't really think that. I think that there is a lot of potential for people to lose jobs. They've been losing jobs on the state and local levels for a while now. So I think that, the people that are in place, if they have a job now, they've got the assets, they feel comfortable, go ahead and make the move. What do you think, Sean?
Yeah, if there is a change, I don't think it's going to be big enough to impact the housing market in this area.
Yeah. I know that's the one thing I think that we're somewhat, and Louis, we talk about this all the time. You're on the West Coast,
right?
And it is we're an anomaly really compared to the rest of the country, because we
agree. But for that reason, you're also a target. But
True.
I do agree with you guys that at the end of these negotiations, you're probably not going to see significant cuts.
No.
But if you did see significant cuts, then you would be the first to feel them.
Yeah, you're right. We're also very transit for military and all that. We have a lot of people that are constantly moving in and out. So more real estate sales are created just based upon people's wanting to move to this area.
But you have seen, though, at the state level where the states were unable to meet their budget deficits, they made cuts, and that did impact the employment rate. But in the D.C. metro area, a good portion of the employment is either directly from the government or dependent upon government contracts.
Yep. And interesting, because before we hopped on here, there was actually an article in the Washington Business Journal. I don't know if you caught it, Louis, but it said Clear Capital Home Data Index report was basically they're projecting that for the Washington, D.C. metro area, encompassing Alexandria and Arlington, that they will lead the nation again in the second half of 2011. They're predicting almost close to a 3% gain from July to the end of this year. And let's see here. It was the top among the 4 major markets, which were New York, Rochester, and Miami. And it looks like they were saying an interesting one, because they said Virginia Beach will actually have a harder time in the second half of 2011. They're expecting an 8.6% decline in prices in Virginia Beach. So I think that what really happened in Virginia Beach, I think that they really got way overheated back, 5-6 years ago. It's interesting. I was listening to Squawk Box the other day too. Warren Buffett came on. I don't know if either one of you caught the interview.
I saw him, yeah.
Isn't it interesting? His take is relatively it was a very positive tone coming from him. And the big thing was about, housing coming back around as far as new construction starting. He was projecting by the end of this year a lot more new construction. Now, in our area, this has been going on for a while now. We've had a lot more housing starts. We're seeing a lot more, lots going under contract before anything even breaks ground, which, they were building a lot more and having them up and then having to wait, but that's not the case. And he was saying, based upon the 500,000 number that's been kind of consistent with new housing starts across the country, he's looking for that to ramp up. And he was even saying that the national unemployment was going to go, what was it, below 8%, Louis?
Yeah, and the problem I have with Warren Buffett is just because someone's good at a stock picker doesn't mean they understand the overall economy. And he's been going on for years about how gold is a bad investment, but gold has outperformed the Berkshire Hathaway by a factor of 2 to 1, I think.
Yeah, his model is also different because he's so, he doesn't, like, if you ask him about something that's going on right now, he's like, I don't care about that. Everything is down,
He has his own views on how to purchase stocks based on, I forgot, there's a value model that he uses, and he's very good at that. But then he also has opinions on the debt ceiling, on taxation, which people listen to him as if he's an expert on those things, but he really isn't. He's an expert on picking stocks.
Yeah. And
I really don't place much emphasis on where he thinks the general economy is going or what we should do about the debt ceiling or how much people should be taxed or where the price of gold should or shouldn't be.
No, but I think the general theme there, one of the comments he made was that, he would consider investing in real estate if he was somebody that had money. You know what I mean?
I think as an investment perspective, yeah, if you're going to get that cash flow, as you and I have talked about many times,
yep.
That makes total sense, especially at these rates.
Yeah, and that's
unemployment's going to go. You may be wrong about that.
Right. Well, that's actually a good segue too, because we've been talking about the national rental prices rising, and I pulled another one from Hot Pads. They showed that I believe it was a 6.7% year-over-year increase in rental prices from last June to this June. And I actually asked Sean to kind of, price out some stuff that's right in the downtown Arlington and Alexandria area. And what were the percentage increases or amount? You can give the amounts really from what they were pricing out last year.
Yeah, the increases were about 5 to 10%, depending on where you look. But I wanted to look at it, take a closer look at it, and look at a few different buildings. One building called Clarendon 1021 on Garfield Street, where I know there's a lot of rental properties there. Across the board, you were seeing probably about $100 to $200 increases. I looked at another neighborhood in Arlington, Alexandria, called Fairlington, and you saw the exact same thing. So rental prices are definitely going up. One of the reasons is inventory with rental prices, just like some areas for home sales, it is very low right now. I've been getting tons and tons of calls from my website for people wanting to find rental properties, and I usually refer them out. But I hear a lot of stories from other agents, and they just can't find all that much. There's just not that much out there right now.
Right. And it's interesting because you said that you had a client or a potential client call you up about his rent being right.
Yeah. A friend of mine, he's been living in a townhome in Falls Church for the past 4 years. He's been paying $2,000 a month. And just this past week, his landlord told him that he was going to increase the rent to $2,300. So my friend, he wanted me to pull the numbers and so he could go back to his landlord with some concrete numbers. But when I check out the numbers, the price it reflected, did reflect that $300 increase, if not more. So
right, and this is somebody who hadn't had his rent raised in 3 or 4 years.
Right. I'm not sure if his landlord just wasn't paying attention to the market or
started reading the national headlines.
Yeah, exactly.
Exactly, which I think is what happened there. And I think that the big takeaway for you listening out there, guys, is that media has been pumping, the rental prices have been rising. Lewis, you and I have been talking about this for 6 months now.
Absolutely.
And just now is it coming to the forefront? I said, it was only a matter of time before, the landlord starts saying, wow, the guy up the road got $400 more a month. Time to raise mine up. And as that continues to happen, you're going to have more and more tenants that actually start to question, well, man, maybe I really do need to look at buying. And especially in the D.C. metro area, I mean, things are going to continue to climb. We have very low inventory. So, in both rentals and existing home sales.
Right.
And Ryan and Sean, what's interesting is rents rise. Obviously, it makes home ownership more attractive and also makes investment in rentals more attractive. But the real kicker for the person who's renting is if you go into a period of time where inflation goes up and you're not in rent control, your rent's going to go up by a certain factor, whereas if you've locked in your low-interest loan now and you bought a home, your cost of living or your cost of housing is not going to increase, while the person who's renting is going to continue to see their rental monthly payments go higher.
Exactly. Yeah, I mean, you're 100% right there, Lewis. I mean, not to mention the tax advantage, and the only thing that can change are your taxes and insurance.
And your ownership advantage. You now can fix the place up. You can do what you want with it.
Yep, I totally agree. We're coming up on a break. When we come back, we will dive into some more of this. Thank you for listening to Real Estate Radio. Be right back.